Right, I think we can begin. Good evening, everybody. My name is Chad Atwell. I'm a financial planner here at NLP Financial Management. I'm co-presenting today's webinar. I hope you're all safe and well. Just a bit of housekeeping before we begin. The webinar today will last between 40 and 45 minutes. We've got a Q&A bar at the top of the screen. So if you want to ask any questions as we go along, hopefully we can address them at the end of the seminar. The session today is being recorded and it will be available on our website within a few days and on our YouTube page in case you want to watch it over again or share with family and friends. So today's webinar, the title is Economic Musings and Tax Year End Planning. It's being delivered by me and my colleague Adam Walker. Adam is a financial planner at Birchwood Investment Management. They are part of the NLP Financial Management Group. My section will be delivered to begin with. It's on economic musings. And I guess what I'm addressing in these early part of this seminar is common questions that I've had from clients so far in 2021. Now, the most popular question is on investment portfolios and how they will fare this year. Clearly, last year, it was quite a tumultuous year in terms of the economy and for portfolios. And as a consequence, portfolios were quite turbulent. But thankfully, across the group, our view is we performed pretty well given the conditions. Now, in terms of what happens to portfolios going forward, portfolios are influenced by a number of factors. And perhaps this question deserves a webinar in its own right. And I'm sure our investment team will be putting something together in the near future. But just answering this at a high level, let's have a look at the factors that influence portfolio performance. So first of all, the portfolio which we put together for you is dependent on what your attitude to risk is, what your objectives are. After that, we put together a portfolio which has exposure to various assets and funds. Those funds are invested in markets, in companies. So markets have an influence on the portfolio. In short, if markets are following an upward trend, this is normally positive for a portfolio. If, however, markets are quite static or fall sharply, as we experienced in spring of last year, this will have a negative impact on portfolios. Now, markets are driven by economies. If economies are growing, this is positive for markets. If, however, there's uncertainty or growth is benign in economies, or we enter some kind of recession, again, we did that last year after the health pandemic started, then this can have a negative impact on markets and portfolios. Other influences towards portfolios are central bank policies. Central banks can control interest rates. If interest rates are low, this gives us as individuals in the population more disposable income, which helps the economy, markets and portfolios. If, however, interest rates rise sharply, this can have the opposite effect in terms of economy, markets and portfolios. Politics also has a role to play. Ideally, what an economy and markets enjoy is a stable government, which is pro-business, pro-economy. This is normally positive for markets and portfolios. If, however, there is some uncertainty, this can cause issues within markets. So an example of that perhaps would be the UK market. The UK market has struggled when compared to a number of its peers in recent years, and possibly that's due to the uncertainty caused around Brexit. So politics can influence how portfolios behave. From time to time, we have themes in the market. So last year was very much around technology and technology stocks, which performed very well when compared to other parts of the market. Most of us were at home. We were using technology to communicate, such as Zoom, like this webinar today. We were doing a lot of our shopping online, and this had a benefit towards technology companies and their share prices rose. As well as all of the above, other factors do come into play. So some are known or can be tracked. For example, we're keeping an eye on inflation at the moment across our investment teams, because that could rise and that could have an impact on markets and portfolios. But some factors are unknown. So again, if I think about the pandemic, this time last year, The view was it was very much contained within China, but within a few weeks of that, it spread across Europe. It's had a bigger impact on economies and markets since then. So a range of factors influence portfolio performance. For me, a big driver is the state of the economy. If we have a positive economy, that's good for markets and portfolios. And on the next slide here, we've got a table put together by the OECD. They put this together in late 2020. What they did was they forecasted what economic growth was across major economies last year and what it could be going forward. As you can see, a lot of the economies across the globe contracted last year. Argentina at the top, for example, the economy there contracted by nearly 13%. The UK a bit further down didn't fare much better. Now, I must say that these figures are estimates. For example, the UK figure is nearer to 10% as a contraction, according to the Bank of England figures provided last week. The good news here is that we are now past 2020. The main driver of last year's recession was a health pandemic. We're hoping that we're getting a better understanding of this virus. And with vaccination, what we hope is that economies can reopen. And as a consequence, we can see some economic growth in 2021 and 2022. Now, if this prevails, that should be good for portfolios. It is, though, only one factor that influences portfolio performance. And as a consequence, we've been keeping an eye on this quite closely. And within our portfolios, we have increased equity exposure. We started this in the third quarter of last year with some exposure to Asia. In recent weeks, we've increased exposure to more riskier funds within the UK and the US because we believe a growing economy will hopefully be beneficial to our portfolios. Now, just going back to that recession in 2020, it was a sudden recession. Ordinarily with recessions, what occurs is, the population become a bit poorer. Wages are lower, profits are lower, and this means we've got less disposable income. But one of the, I think, anomalies of this recession has been that household savings have actually increased. Thanks to the internet, most of us were able to work from home. Business in some cases operated normally. So across Birchwood and NLP, we've been working from home and continued to offer our service as we were doing prior to the pandemic. So we've been earning wages, but because we've not been able to go out and spend those because of lockdown, it's meant that excess savings has increased quite sharply. So the chart in front of you, it's been put together by the Bank of England, sort of maps out household savings in 2018-19. And you can see in 2020, surplus savings has risen quite sharply. The Bank of England have suggested that excess savings could be in the order of 125 billion. Now, this is not just a UK anomaly, I would say, from a recession. It's happening across the globe, across most developed economies. And what the hope is that as and when economies reopen, we will have disposable funds, which in turn will help businesses because we'll be spending, buying goods, items, possibly traveling at some stage. And this will help with the economic bounce back. Now, as a consequence of this anomaly, these savings being built up, a question that I've had quite frequently so far in 2021 is what to do with these surplus savings. As a financial planner, I would recommend you speak to a financial planner because everybody's circumstances are different and therefore the advice is different. At a high level, when I'm sitting down with clients, the sort of things we can consider are reducing liabilities. Now might be a good time to use surplus funds to reduce mortgages, credit cards, loans, and make a significant dent in those borrowings. If money is sitting in your cash account, it's important to earn a competitive rate on that cash, and I'll speak about that in a moment. As well as that, this might be the year where you want to utilize certain tax allowances. A number of people I speak to are making pension or ISA contributions for the first time, or are increasing those contributions and perhaps using the entire limit. Once funds go into ISAs and pensions, they can then be invested, and hopefully that means that those surplus savings are growing more than what they would do should they be sitting in your cash account earning a lower rate. But again, what I'd emphasize is speak to your financial planner. Advice for everybody varies. In recent weeks, I've had scenarios where we've reduced withdrawals from portfolios because quite simply that level of withdrawal isn't required for ongoing spending, and clients want to keep money in the portfolio in the hope that it generates a higher return. We've done exercises where people have made gifts for inheritance tax purposes with these surplus savings. So do speak to your financial planner. Moving on, one of the areas where many of us are looking to keep this surplus cash is in a savings account. The chart in front of you has been put together just mapping out the Bank of England base rate over the last 20 years. Gone are the heady days of being able to earn 5, 6, 7% on your cash in deposits. In the last financial crash, the base rate went all the way down to 0.5%. And once the pandemic started here, the base rate went down to 0.1%. The expectation at the moment across many commentators is that that base rate could go down further still. As a consequence, it's important to carry out a review if you've got surplus savings. It's clearly important to keep those surplus savings if you're concerned about what might happen in the near term. But if there's surplus savings there that you're looking to keep for a while, it's probably important to look at your other options. So what are these further options for surplus cash? Well, I'd go back to considering looking at tax wrappers such as pensions and ISAs. We're getting more inquiries on structured products. Structured products are a kind of a halfway house between cash, because you can secure part or all of your capital, and investments, because you can earn a return linked to markets. So certainly I'm having more conversations around structured products with people. Ultimately, in our view, an investment portfolio for surplus cash is an appropriate option. The benefits of an investment portfolio is that over the medium to longer term, hopefully the return will be higher than cash. And if it's managed tax efficiently, in real terms, it makes a big difference. One of the risks, though, with investment portfolios is that we are still in the middle of a pandemic, and there is a risk that markets could fall and therefore the value of a portfolio could fall. As an example, we can look at a lump sum investment. So what I've got in front of you is a chart. The assumption is that £12,000 is invested at the start of January 2020. It's invested into the FTSE 100, the biggest stock market in the UK. And as you can see, the value of that 12,000 fell steeply last spring. This is when the pandemic started. The economy went into a sharp recession and markets fell sharply. Over the year, that £12,000 did recover, but by the start of December 2020, the value of that investment was approximately 10,276 based on this analysis. So naturally, we're concerned that something similar could play out in 2021. And when I'm having this conversation, what I'm suggesting is possibly making regular investments rather than a lump sum investment. So on the next slide, we've got an investment of £1,000 per month, again into the FTSE 100, again in 2020. The total investment is £12,000 over the course of the year, but you're investing that amount monthly rather than a lump sum at the beginning. And as you can see, the investment experience is entirely different. The reason for this is that you're still buying sort of units in the FTSE 100 when the market fell in April and May. And the balance here is nearly 12,200 by the start of December. So investing on a regular basis might mitigate some of the timing risk, some of the volatility within markets, and certainly is worth considering if you're looking to enter the market, but you're concerned about any short-term falls. Now, this time of year, we have a number of clients topping up their pensions in ISA. And again, once the money goes into the pension in ISA, at Birchwood and at NLP, we're able to drip feed that money into markets once it's in the wrapper. So speak to your financial planner in connection with that. Now, another conversation I've had quite frequently in client reviews is government debt. So the government had to intervene last year once the pandemic started and had to put in place support measures in order to help the economy. So there were support measures for businesses, for individuals, such as a furlough scheme, and other various support measures. As a consequence, government debt has risen quite sharply. So in the graph in front of you, put together by the Office for National Statistics, the orange bar to your far right shows government debt as a percentage to gross domestic product. And as you can see, debt has risen quite sharply. It's nearly now 100% of gross domestic product over the last year. Now, that is as high as it's been since the late 50s, and the Chancellor has some choices to make. So when I've had these conversations, generally it's around are tax rises on their way? We have to acknowledge that government debt is high. The Chancellor of the government will do that as well. The question is, when will they start to balance the books? If you go too soon, this could stunt an economic recovery. And if you go too late, this could have an impact on Britain's credibility to repay back this debt, which in turn could lead to higher interest rates on that debt and could have other ramifications on currency, etc. So there is a lot of talk at the moment that tax rises are potentially on their way, a question of when and which taxes. Ordinarily, I think a government would look at income tax, national insurance and VAT rises. However, the Conservatives did pledge in the last manifesto prior to the election that we would not see any rises in these taxes during the current government term, albeit we didn't have a pandemic at that point. As well, an income tax, insurance and VAT rise may have quite a negative impact again on spending and growth. So perhaps we're not going to see some change, but we're not sure. Other taxes that have had speculation is corporation tax. Corporation tax in the UK is very low when compared to our peers, Germans, the French, the US. However, I guess the downside of increasing corporation tax is that we're relying on businesses to help with the economic bounce back, to hire people who have lost their jobs, and therefore increasing corporation tax at this stage might not be such a good idea because it could stunt the recovery. There have been rumours about other taxes, online sales tax, a wealth tax. Online sales tax is something that's been discussed globally. It's quite easy to, I guess, discuss, maybe harder to implement because very few countries have yet introduced anything on that front. A couple of taxes and a tax relief that has had a bit of mention in recent press is capital gains tax and pensions tax relief. Now, capital gains tax is a tax that's levied on profits, so it's charged to a gain when you sell an asset. It's the gain that's taxed, not the amount you receive. And before the gain is taxed, it can be offset against any capital gains tax losses that you can bring forward or an annual allowance of 12,300. Even after those exemptions have been offset against the gain, the standard capital gains tax rate is lower for basic rate taxpayers, higher rate and additional rate taxpayers. So the table in front of you compares capital gains tax rates. You can see for a basic rate taxpayer, they would pay 10% on a capital gains tax liability, whereas they would pay 20% income tax if it was an income tax gain. Now, a report last year put together by the Office for Tax Simplification suggested that it might be appropriate to equalise these taxes. So we could see some change with capital gains tax. As a consequence of this, we've been doing quite a lot of planning so far, where we're ensuring that perhaps we're using losses and annual allowances for clients. And this may be something that you want to discuss with your financial planner in case any changes do occur. Another tax or a tax relief which has been discussed is pensions tax relief. Now, pensions tax relief is quite generous. If you look at the table below, let's look at a higher rate taxpayer. If a higher rate taxpayer put £80 into a pension, they would get tax relief of £20 when that money lands in the pension. So a total of £100 would go into the pension. The taxpayer would then complete their tax return claiming another £20, meaning the net outlay to get £100 in your pension is £60 for a high rate taxpayer. Now, tax relief does cost the government quite a significant amount of money. This is something that's discussed. It does the rounds this room before most budgets and autumn statements, and it's possible that some change could take place here. Although, again, there are certain challenges in terms of the way the system works, and clearly changes in tax relief might be unpopular. But once again, when we're talking to clients, we are talking about potential tax relief changes, and therefore, where appropriate, we're recommending making contributions before the end of the tax year, perhaps even before the budget, and maybe using things like carry forward, where you can make higher contributions if you're worried about tax relief being changed. So that's, it's a regular question I've had to do some planning. I'm now going to hand over to my colleague Adam, who's going to share some tax year end planning tips with you all, and I'll see you at the end of the seminar to wrap up. Many thanks.
So thank you, Chad. Some very interesting observations of the current financial and economic climate, and certainly some interesting things to think about. I would now like to touch on some of the most common areas and the products that be considered as we approach the end of the tax year. And what we're about to run through is a whistle stop through some of the more popular products with some fairly basic tips, but it's by no means a comprehensive list. So I would encourage you to speak with your financial planner to see how you may be able to take advantage of some of the available options. Now, it's that time of year when many of us will have logged on to the HMRC website and filled in our self-assessment tax returns in order to meet the end of January deadline. It can be quite a soul-destroying process. It can require quite a lot of work, and at the end of it, the reward is usually a tax bill to pay. But if you haven't taken any action previously, there's not a great deal you can do to make it better this time around, because you're paying for last year's tax, so the 1920 tax year. But there are some things we can do to save tax in this financial year before it ends on the 5th of April, which could make next January a little easier in terms of our tax affairs. So the first area I'd like to talk about would be pensions. So when discussing possible opportunities to reduce tax with clients, as we approach the end of the tax year, pensions are always a very good place to start and can be one of the most effective ways of reducing a potential tax bill. So what is a pension? Very simply, a pension is a long-term savings vehicle designed to help people build a fund towards their retirement. Now, they're long-term, as generally we cannot access the pension benefits until we're 55, but this is actually likely to move to 57 from 2028. And the state pension age has no link to this age whatsoever. Now, in my view, pensions are currently one of the most tax-efficient ways of saving or investing, as they offer a number of advantages. First of all, any pension fund will grow completely free of income tax and capital gains tax. Also, when taking the benefits, we can currently withdraw up to 25% of the fund as a tax-free lump sum. And the remaining fund would be taxed as income at our highest marginal rate as we withdraw that. Now, as Chad has shown on his previous slides, pensions can also offer some very attractive savings due to the tax relief that they offer on contributions. And again, to recap, the UK taxpayer can receive tax relief on any contributions at their highest marginal rate. So whether that's 20%, 40%, 45%, or even actually there is a tax relief available at 60% in some occasions. Now, 60% may be a bit of a surprise, as it's a fairly hidden in the way that it's charged, which is why I'll try to explain very, very quickly, as simply as I can. So since the 6th of April 2010, the personal allowance is reduced by £1 for every £2 of income over and above 100,000. So this means that when our income reaches £125,000 a year or more, the personal allowance will be taken away completely. Now, once the personal allowance has been taken away, not only do we pay 40% tax on any income above 100,000, but we also pay 40% tax on the income that would have fallen within our personal allowance. So this gives an effective rate of 60% for income between £100,000 and £125,000. Now, if this affects you in any year, making a pension contribution can effectively reduce your income and protect your personal allowance, resulting in tax relief of 60%. But it may be that you use your income doesn't create an issue with your personal allowance. It's nowhere near 100,000, but sometimes other forms of taxable income that may not be regular will have an impact. And we've seen this many times at Birchwood and NLP, because some people might be receiving a taxable redundancy payment, some payment in lieu of notice, or even just an annual bonus payment could push them over and above that £100,000 on top of their salary. Now, unfortunately, there is a limit to the amount that we can contribute to pensions whilst receiving tax relief, and this is known as our annual allowance. And currently we can contribute 100% of our pensionable earnings into a pension. That's every year, but it's capped at £40,000. Now, the pension annual allowance can be carried forward for up to 3 years, but it will be lost eventually. So we should consider every year whether we've made as much use of our pension annual allowance ahead of the end of the tax year, as it may be possible to make a significantly larger contribution than we first thought. Now, the annual allowance will reduce to £4,000 once you start to withdraw income from certain pensions, and it also reduces if your earnings exceed £240,000 per annum. But as well as the income tax advantages, one of the most attractive features of a pension is the tax treatment on death, as they can be an effective way of reducing any potential inheritance tax liability. This is because any pension fund can be passed on to nominated beneficiaries on death and be outside of your estate for inheritance tax purposes. For this reason, it can sometimes be sensible to draw from other investments such as ISAs before accessing pensions. Okay, so moving away from pensions onto other options. So I'd now like to just discuss ISAs. Again, it's something we're probably all very familiar with, but an ISA is essentially just another tax efficient savings or investment vehicle with a tax-free wrapper around it. Now, ISAs, like pensions, are a great way to save for the future because your investment returns are again free from income tax and free from capital gains tax. But also the fund can be withdrawn free from tax. So whilst there's no tax relief on contributions as you would receive with pensions, every adult can save a maximum of £20,000 each year into ISAs, whether that be a cash ISA that you might have with your bank or building society, or a stocks and shares ISA, or a combination of the two. But at Birchwood and NLP, we can provide advice on a number of stocks and shares based options to suit your own objectives. So again, please speak to your financial planner if this is something you wish to explore further. Now, a contribution of £20,000 may not seem significant in isolation. However, if the allowance is utilised for a number of years and achieves a reasonable level of growth each year, this could build a meaningful lump sum, which could be used to repay a mortgage, for example, or for other large purchases or expenditures, or even generate a tax-free income to supplement our pensions in retirement. Now, importantly, unlike pensions, if you don't use all of the allowance, it can't be carried forward. So it's very much a case of you use it or lose it. So those of you with any unused ISA allowances for this year should consider using it if you can before the 5th of April deadline. So, but if you don't want to commit fresh money to the markets, or in order to use your allowance, or if you don't have any spare cash at the moment, you can carry out what's known as a bed and ISA exercise, which involves funding an ISA contribution using assets and investments that you already hold outside of a tax shelter. Also, you may have existing cash ISAs that are instant access or coming to the end of their term. And as Chad mentioned earlier, interest rates are at an all-time low. So you may wish to consider other options with these accounts. Now, it is possible to transfer existing ISAs from cash to stocks and shares in order to achieve a greater growth potential without impacting your allowance for the current year. But again, you should speak to your advisor about reviewing existing ISAs or funding ISAs via existing investments. So please do get in touch if that's something you want to talk about. But going back to my point about utilising our allowances, you can see from this table how using even part of your allowance can build a significant sum over a term of 10 years or 20 years. So one example, investing £500 each month for 10 years, achieving a 5% annual return, could give you a fund of just shy of £77,500 after 10 years, or £201,000 over 20 years. But maximising your contribution by investing the £1,666 a month, so that equates to the £20,000 over the course of the year, can actually give us a fund of £258,000 after 10 years, or even £678 after 20 years. So some really significant numbers there that could be used, for our later lives. Now, of course, it's possible to invest a lump sum rather than paying in monthly, so whichever suits your situation at the time, anything could be possible. It can actually be a combination of lump sums and regular monthly contributions as well. So that's just kind of the regular ISAs that perhaps we come across quite regularly, but there are some other ISA related options as well that are out there, which I'll just touch on a couple of those. So the first one I'd like to speak about is the junior ISA, or JISAs as they're sometimes known. And just like a normal ISA, any fund would grow free from any income tax or capital gains tax. And like adults, children also have tax allowances that can be utilised each year. And the junior ISA allowance is now a very generous £9,000 a year, which enables you to start building a very healthy fund towards what could be university costs, learning to drive and car purchases, or even house deposits, as we know how difficult it can be for younger people to get on the property ladder in the current climate. Now, they won't be able to access the money until they're at least 18, at which point it automatically turns into a normal ISA and transfers into the child's own name, giving them full access. But I think that's quite an important point, as a parent may not want an 18-year-old to all of a sudden gain access and control to what could be a reasonably significant amount of money. But junior ISAs can also accept transfers from old child trust funds. So those of you who kind of created the child trust funds in the past can actually move these into the more modern junior ISA. But given the likelihood that junior ISAs will be long-term investments, depending on the age of the child, it may be sensible or reasonable to adopt a slightly more adventurous approach with the underlying investment in order to maximise the growth potential. And if you prefer something even longer term, you can pay £2,880 into a junior SIP as well each year. And because that's a form of a pension, the government would also give you tax relief, boosting that to £3,600 every year. So either a junior SIP or a junior ISA is a great way to encourage children into the savings habit and using tax efficient shelters from an early age. Again, very briefly, the last sort of ISA product that I'll touch on today, but the lifetime ISA, which superseded the Help to Buy ISA. But unlike most ISAs, a significant benefit of a lifetime ISA is that any money paid into them will benefit from a top up from the government. So in the same way as pensions would be. And with the lifetime ISA, you can get up to £1,000 a year in the form of a government bonus up to the age of 50. You can only open a lifetime ISA if you're aged between 80 and 40, and you can invest up to £4,000 every year. Now, you can withdraw the lifetime ISA money once you've reached age 60 or to buy your first property, but not before, otherwise you would lose the government bonus. Now, so they're just sort of some of the general sort of ISA options available to us. And if you've exhausted all of your pension and ISA options, you may wish to consider other types of investments, and we can look at perhaps venture capital trusts or VCTs or EISs, or which are known as enterprise investment schemes. They may attract some additional risk in comparison, but also offer some very attractive tax savings. Now, a venture capital trust or a VCT are basically investment companies listed on the London Stock Exchange, where any money invested into a VCT will receive a 30% income tax credit on investments up to £200,000. The investment must be held for at least 5 years in order to gain that. Now, any dividends are paid tax-free, and no capital gains tax will be charged on disposal, but they are generally higher risk investments focusing on smaller or early phase businesses, and the shares are unquoted or listed on the alternative investment market. But because essentially they are higher risk than most investments, the rewards can also be higher as well to compensate you for that additional risk. And then EISs, or the Enterprise Investment Scheme, have several similarities to VCTs, although again the risk is another, I suppose, notch up even in comparison to VCTs. Again, they're designed to encourage investments into early stage or unlisted companies. Again, as with VCTs, any investments will receive the 30% income tax credit on investments, but up to £1 million rather than 200,000. And the shares must be held for at least 3 years as opposed to the 5 that you need to hold the VCT. But one, I suppose, more interesting factor about the EIS is that if you hold on to the investment for 2 years or more, then the investment will fall outside of an individual's estate for inheritance tax purposes. So there are some estate planning advantages with EISs that perhaps you wouldn't get elsewhere. And the fund also benefits from tax-free growth, but a capital gains tax deferral, which may not be a huge benefit if the rules changed, as Chad suggested that they might be looked at at the next budget. Now, these options won't be suitable for everybody, but at Birchwood and NLP, a great deal of research and work is carried out to build a comprehensive panel of options in this area. And it is possible to build a portfolio of VCTs or EISs, enabling you to spread your investment risk further. But they are very complex investments, so please talk to your financial planner if you'd like to discuss these options in more detail. But now, just kind of moving away from products, we also have various allowances that are available to us and exemptions that can be put to good use every tax year. So allowances, again, something that Chad has touched upon already, but our capital gains tax allowance. And as we approach the end of the tax year, we often discuss capital gains and how making the most of the allowance may be used in our favour against the revenue. Many investments are designed to generate capital growth instead of income, so we can offset some or all of that growth each year against our annual capital gains tax exemption. Now, a capital gain applies where an asset is purchased and then later sold at a profit, and it's only the profit that is then assessed as a capital gain. Now, the exemption is currently £12,300 per person each year. So any gains from joint investments can be assessed against both annual exemptions, meaning that nearly £25,000 of profit can be realised free from tax every single year. Now, should the annual exemption be exceeded, any gain is then charged at 10% for the basic rate taxpayer and 20% for the higher rate taxpayer. So still more favourable rates in comparison to income tax. And then an additional 8% is chargeable in both scenarios if the asset being sold is a second property, basically. Then one final thought when trying to maximise the tax efficiency of our finances is that not all of us are in a position or a stage of our lives when we're still accumulating wealth. Some are now at a stage where it's now time to withdraw money or to supplement income, maybe to pay off a mortgage or a debt, or maybe even to give money to children, whatever it may be. So just to finish, a very brief slide just to demonstrate how using our allowances where possible can allow us to generate a tax-free income. So we have our personal allowance. So it's the income tax personal allowance. It's currently £12,500. That's the first £12,500 of our taxable income that we can receive tax-free. Now, that includes pension income in excess of the 25% tax-free amount that we can receive on the basis that we're not in receipt of state pensions or any other source of taxable income. And as we've already seen, some growth in investments can allow us to realise capital gains instead of income, which can be offset against our annual capital gains tax exemption. So that's another 12,300 of just purely growth that we can release tax-free. And a withdrawal is likely to comprise of both capital and growth, but any return of capital is not taxed, it's only the profit. And of course, ISAs. So ISAs are tax-free, as we've already looked at. If we've made use of our ISA allowances consistently over the years, we should have a healthy fund that we can draw on without any tax constraints at all. And then it's just a case of basically discussing with your financial planner in which order and how much to draw on each of those areas would be most efficient for the individuals. So by using a combination of our allowances and tax efficient investments, we can generate a good level of tax-free income or capital when it's required, but it's important to have a strategy in place. And then finally, some other exemptions to consider, which are also kind of tax year sensitive. So estate planning is something that we should all be looking at. And the first step in reducing an inheritance tax burden is to ensure that all allowances are used. And you may already be aware that there are several small exemptions that you can make use of during your lifetime in order to reduce the value of your estate. So just some of the more common ones. So the annual gifts, you can give away gifts of up to £3,000 in total each year. And these gifts will be exempt from inheritance tax on your death from day one. You can carry forward any unused part of the £3,000 exemption to the following year. If you don't use it in that year, the carried over exemption will expire. We then have individual gifts, so you can make small gifts of the value of £250 to as many individuals as you like in any one tax year, but you can't give more than £250 and claim that the first £250 is a small gift. And if the gift is for an amount greater than the 250, the exemption would be lost altogether. It wouldn't be recognised if the revenue were to look at it. And furthermore, you can't use the small gifts allowance together with any other exemption when giving to the same person. And then regular gifts as part of normal expenditure. So again, any regular gifts that are made out of after-tax income, your net income, not including capital, are exempt from inheritance tax. They'll only qualify if there's enough income left after making your gift to maintain your normal lifestyle. So it's particularly useful to stop the build up of surplus income increasing the value of your estate. As an example, you may be in a situation where you have £1,000 left of your taxable income each month that would otherwise just build up in your savings account, which would give you £12,000, added onto your taxable estate every single year. The taxman is obviously going to get his hands on 40% of that, whatever's building up. So you can actually sweep that away, give it to one of your beneficiaries, and that would disappear outside of your estate from day one. So that brings us to an end of what was a very high-level summary of some of the most common products used to maximise tax efficiency of our clients' financial affairs each year. So many of you may already be familiar with these options, but please don't hesitate to get in touch with your advisor in plenty of time before the 5th of April, should you wish to discuss anything in more detail. But that's it from me. I hope it's been helpful, and I will now hand you back to Chad just to summarise. Thank you very much.
Thank you, Adam. Well, we hope you all enjoyed that today. In summary, do speak to your financial planner to understand what options are appropriate for you. It's not always about new investments. It's often about just optimizing your current position and using your allowances sensibly. And if we do get change coming in on the way, it's important to reassess your position on a regular basis, which again is part of our service. Okay, so that's all from us today. Hopefully you found today's session enjoyable. There's some risk warnings coming up on the screen. As I said, there'll be a copy of this presentation available on our websites within a few days and a recording on our YouTube page. Many thanks. Stay well.